The math is completely broken the housing market, and it's changing everything. This is exactly what you need to know if you're a buyer, seller, or investor, or even a renter in today's market. That could change the way you think about what's happening next and what's happening today in the market so you can position yourself to win. So let's dig in. This is a huge article that just came out about a Gallup poll that basically shows that home buying intentions of the U.S. adults who don't own a home. The question was, based on what you know about right now, do you think you will buy a home in the next year, in the next 5 years, in the next 10 years, or are you unlikely to buy a home in the foreseeable future? Well, the results showed us that only 25% of U.S. renters expect to buy a home in the next 5 years. The surprise about that is it's the lowest levels ever recorded. Just in 2013, 57% of young adults expected to buy during this period. So the buyer, unfortunately, can no longer support the current pricing because we are ultimately in an affordability crisis. Homes that used to be priced at $180K back in 2013, where most young adults expected to buy, are now priced at $450,000, but wages haven't kept up. And now there's a massive disconnect between what sellers think they can get for their house and what buyers can actually afford to buy one. And that's basically showing us that the math stopped working. So sellers are ultimately stuck. And this is why we're seeing tons of inventory creep up every single month in specific markets across the United States, month by month. Now, household income needed to afford the finance purchase of a typically valued home has been skyrocketing. Look at this. You can see back in January 2020, it was $52,000. And today it's $93,000. But the problem is areas like Jacksonville, Florida, where the median income for a family is only $68,000. So there's a massive disconnect. Unless wages keep up and start growing rapidly, we are going to have to see prices come down in real estate, which is badly needed for the next generation of home buyers. And the income needed to buy a typical U.S. home has increased 79% in just 6 years. Let that sink in. That's a tremendous amount of growth in a short period of time. It's because prices went up and then interest rates moved up. And wages didn't go up 79%. Productivity, the American dream, basically just got 79% more expensive. And people are wondering why housing demand is freezing. Actually, the rate of turnover of houses is one of the lowest on records also. It's 2.8% last year. And we expect to continue to see sales grind along the bottom until sellers become realistic with their price and start bringing the price down. Now, who can still buy a house? We're actually finding out that about only 29% of buyers can still afford to buy a new house. A new analysis from the National Association of Builders found that 71% of Floridians cannot even afford a newly built home at the current prices and mortgage rates. Yet these builders continue to build starter homes for $500,000 with practically zero lot lines. They're often 2,000 to 2,500 square feet, 3 to 4 bedrooms. They have zero lot lines, very small backyards. They're stick builds, and they're just packed in. Who do they think is going to be able to afford to purchase them at these prices that they're offering them today? And this is where we're seeing a massive housing mismatch. We're seeing tons of basically pre-luxury or mid-level luxury homes on the market. We have a glut of supply of that, but we're missing the affordable starter homes and the workforce housing homes across the board. And so the unfortunate thing, and we'll bring this in later in the video, is I'm going to show you the migration data of why that's starting to break the Florida market, starting to break the Texas market, because we're actually seeing people leave Florida now in certain cities versus continuing to move to it. But you can see in the Northeast, you're seeing that tons of people, or out in Washington and Oregon, that tons of people are priced out of the homes because the prices are just simply too high and the wages are not keeping up. And this is a story that you definitely want to watch if you're a real estate investor or even a renter, because you need somebody to help you do the math on your property. If you're a renter looking to buy, you need to get in with a top real estate agent in your market. Every market is micro. If you want to connect with me, I'm more than happy to put you in touch with somebody who knows what they're actually talking about for your specific market. 80% of agents are not very good. And so if you want to get with a top agent, reach out to me. My email is john@movewithmomentum.com, and you can see that information below in the description as well. But for right now, what you need to know is that buyers are completely priced out and you need to run the math. Look at this housing affordability index. In 2007, we saw this massive affordability spike because prices prices came down 30 to 40% in many areas, and some areas more, especially if they're condos or townhouses. And people gobbled up real estate during this time period. Well, affordability just stopped because in 2020 prices skyrocketed, and then in 2022 we see the affordability just drop through the floor because the Fed raised rates from 0 all the way up, to where they are today, where the mortgage rate is now 6.37%, and it's basically staying elevated there. It's getting a little bit better. We're seeing regional improvements in the Southwest, Midwest, and Northeast because prices are starting to come down. The sellers are having their listings stack up on the marketplace, and then also mortgage rates came down from about 6.7 to 6.3, but we know that buyers are starting to gain power, and this is really important for you to understand if you're a buyer looking for this market. And if you're a seller looking to sell, you need to get realistic on the price. Because the big question that you have to ask if you're a buyer is, why would I buy this house if it's $2,800 a month for a payment to buy when I could rent that similar house for $1,900? That's that blue line. This is the difference between the mortgage payment to buy on the green line and the monthly rent. And I can invest the rest of that money into the stock market or somewhere else. So this is just simply a massive problem. Well, the other problem too is that rents are now falling. In certain areas of Florida even, the rents are down 15 to 20% already, and that's putting more pricing power on existing home sales, new home sales, because people are saying, well, why would I buy that house if I could rent it for so much less? And now we're starting to see a glut of supply of rentals hit the market, because what happens is the seller goes to list their house, they're unable to get the price that they want, and then they pull their house off the market. They try to rent it. They can't rent it out. It sits on the market for 90 to 120 days until they get realistic, and they either rent it at a low price or lower than they were hoping to get, or they relist it at the price that'll actually sell. And so this process generally takes sellers about 8 months to realize what's actually going on. But it's because the buyers have options. They don't have to buy your house. They don't have to build equity over the next 30 years. They can keep that equity and invest it in the stock market and simply rent and have you carry all the costs as the seller. So it's something that you need to be thinking about. But the major issue is that ultimately wages are not keeping up with inflation. They did keep up with inflation for the last prior years. You can see the year-over-year change in U.S. average hourly earnings for all private employees. This blue line was above trend, above inflation, but now we're seeing inflation start to spike up again, with oil prices being near 100. You also saw this massive decline in U.S. real average weekly earnings year over year. In 2022, we saw it start to fall in real terms, which means that inflation is accounted in it, and then it started to get a little bit better every single time. But the problem is that wages aren't keeping up with the actual inflation of shelter costs, which is one of the major components in the marketplace. And because of this, delinquencies, because more money is getting tied up in other areas for people's pocketbooks, delinquencies are starting to pile up for practically everything. You see it in credit cards, you see it in car loans, you see it in student loans, you're seeing it even in household foreclosures. You're seeing foreclosures start to spike. You're seeing delinquencies in FHA mortgage go all the way up to 13%. So the budgets are strained at this point in the market cycle, and it's likely going to get a lot worse moving forward. That's why I always make fun of, people are financing burritos on DoorDash, and it's very real. These loans are absolutely real, and you're basically having this K-shaped economy where you have these people who are making tons of money, they own assets, people who don't own assets, and they're inflating their wages away, so they're not able to get ahead, and they can't buy any real estate. Well, this affordability crisis has just hindered demand. And when you have demand drop so much, and at the same time you have supply come on because you have these builders that are overbuilding this mid-level luxury, you're starting to see inventory jump to pre-2020 levels. You can see this map come from Reventure. It's housing market states above pre-pandemic inventory. There's now 14 states that are now above the 2019 levels of inventory. This is no longer just Florida and Texas, right? That was everybody's argument. It's just Florida and Texas, just Florida and Texas, where they overbuilt and these, the prices are correcting. It's not true. Look at what's happening in Colorado. Look at what's happening in Washington and Oregon. This is starting to spread across the board. We have a lot of friends that are in North Carolina that are really starting to see prices come down because the inventory is stacking and the demand just doesn't make sense anymore. We used to have all of these people start to move from the Northeast all the way to Florida, and now these people are now relocating to the Midwest to try to find where the affordability is so they can stretch their wages versus the shelter costs, which is, again, the major major component for most people. Look at what's happening in Tennessee. So this is a story that's starting to spread across the United States. Obviously, in the Northeast, we're not seeing exactly what's happening in the South. We're actually seeing less inventory. So this is where you need to understand you need a top agent in your specific market who knows exactly what's going on. Again, I'm more than happy to reach out and get that information for you. Now, here's another chart that I like because it shows the stark contrast between what's happening in Florida and Texas versus the Northeast inventory. You can see in 2022, we just had this massive jump in inventory between Florida and Texas. And Northeast didn't have that because they did not have the massive levels of construction that we had in Florida and Texas as builders and speculators really tried to drive the markets and get as much profit as possible. The Northeast inventory, it's much harder to build there. They have more regulations. There's more not in my backyard type of folks. And then Florida and Texas just expected these people from the Northeast and the out West to continue to move to their markets, and they're just behind by 2 to 3 years. They have to finish the projects that they started. So this is where we see the stark contrast coming in. Again, real estate is very micro and regional, so you need somebody who really knows your individual market. But ultimately, what's happened in Florida is they basically had a payment shock. And this is why you're starting to see migration really start to slow to Florida because it's no longer affordable. Also, during 2020 to 2022, we had this massive demand shock due to the coronavirus, which basically caused all these people to come to Florida. And then we had this massive boom in prices, and it priced out all the locals. And that made the monthly payments just skyrocket, where the locals can no longer afford to purchase. So look at this. In 2013, the median house price was $180,000. This is actually when I bought my first house, 2014. I bought one for $190,000. The rate at that time was 4%. You could have a payment of $690 if you can actually believe that. Just a little bit more than a decade later, we're talking about the median home price being $408 and the rate being 6.7. So we saw the prices more than double, and we saw the rates move up drastically. That caused the payment shock to basically go to $2,100, $2,250. Well, wages did not keep up with that. So people, and here's the truth, people don't buy prices, they buy payments, and the payment is the number one thing that drives the real estate market. In fact, mortgage rates are responsible for up to 80% of price appreciation. So obviously, when rates go up, real estate prices go down, and that's exactly what we're seeing across the board for the majority of the country at this point, and it's starting to spread. So once you add in the homeowners insurance, which are up 70% plus in just 6 years, taxes, HOA maintenance costs are up 50% in a few years. The cost to carry your mortgage for one of these median price homes is $2,700 to $3,500, which is absolutely insane, which is eating about 40% of people's wages and shelter costs, which is unsustainable. There's the rule of 28 that says it shouldn't be above 28%. So we truly are in one of the greatest bubbles here in Florida and in the Sun Belt because of this. And because we're in a bubble and there's an affordability crisis, what we're seeing is net domestic migration is shifting, right? So that's for two reasons. One, people already relocated here who wanted to. They basically pulled forward 10 years of demand in 3 years. And then number two is that we're no longer affordable. So we're no longer attracting that next young working family to Florida because we just don't have the affordable housing for them to live in because the builders aren't building in that price range. And so we've seen domestic net migration to Florida drop 93% from the peak, yet the builders continue to build in price points that they can't afford for various reasons. But the international immigration is also down 70% too to Florida. So we're seeing basically a massive supply come to the market, and then we're seeing demand collapse. So Florida's demand engine has slowed down while the supply has exploded, and that's why we're seeing the rent prices and the sales prices start to creep down every single month. Now, this is just the truth. This is really showing up in new construction for the builders, right? The builders would do anything not to cut their prices. They want to give you incentives instead because they know if they cut the price for that, it'll become the appraisal for all the next houses. So they can't cut on price alone. They need to give you incentives that don't get tracked. And what we saw was in 2023, we saw the peak prices. This is for Lennar. It was $490,000. I can't believe people bought basically brand new median price home like Lennar properties for $491. There's so many of those around our communities, but with the incentives, and this comes from their SEC filings, they're all the way down to $374. So they've dropped more than $100,000. You know, if the market was strong, the builders wouldn't be giving these massive rate buy downs where they can buy you down to 3 to 4%. And the problem is, if you sell that house you lose that benefit. So it's actually better if you just negotiate on price than get the low interest rate, because price is ultimately what'll show up when you go to sell the house, especially if you don't plan on being there for the full 30 years of the mortgage term. But we're ultimately seeing pre-pandemic pricing of Lennar Homes and a lot of other builders who are just scrambling to sell their inventory as fast as possible because they're seeing the demand slow down, and then they're seeing the inventory continue to stack up. So look, this is a great thing for buyers. It's a great thing for renters. But if you're that buyer that bought from 22 to 25, you're basically underwater now, including the transaction costs of getting in and out. And that's a huge problem for those folks that bought in those communities that are still under construction. So this is important to understand, because these prices could absolutely continue to move lower, because the discrepancy between what you can rent the house for and what you have to pay to buy it are still $1,000 away, which means to me that unless we see rates really decline another 2% from here, which I don't see happening, it's likely that the prices will have to continue to come down. So here's what we're seeing today, right? Housing demand is increasing a little bit because mortgage rates got a little bit better and sellers are starting to cut prices, but we're still grinding along the bottom. You can see this huge drop off right here. Now, this is from Reventra's Home Buyer Demand Index, which basically shows mortgage application, pending sales, internet searches, and buyer sentiment. And this is very dangerous. When you have inventory rising and your pending sales and your demand are dropping, this is where we get into these bubble type events that then pop. So ultimately, when you look at it, you're seeing pending home sales are collapsing, housing demand has tanked, but the Midwest specifically is doing better. We're actually seeing an acceleration of home sales happen there and in the Northeast, but the South is not doing well and the prices are coming down. So this is very much regional. But we're continuing to getting this narrative pitch that we have a housing shortage. This couldn't be further than the truth. There's 46.3% more home sellers than there are buyers in February 2026. We'll continue to share this data with you so you can see what's happening. Buyers are now in control in the most markets around the country. And this is the biggest difference between buyers and sellers since Redfin began getting this data and publishing it in 2013. We expect this to actually change more and get worse over time. We think that demand will continue to grind along the bottom until prices come down and sellers will continue to move up. Now you're seeing this little dip right now. We call this the rage quitting scheme, where sellers get so upset that they can't sell their house. Again, they become an accidental landlord. They try to rent it, then they get upset and they relist it, 12 months later, and they then accept the price that the market's willing to do because sellers are emotional. This is a very large transaction for people. It's not easy to transact real estate. So these are one of these things where you're going to see the market not go straight up all the time. You're going to see it basically zigzag based on what's going on in the marketplace. But I expect to see more sellers go and sell their home, and then buyers continue to grind along the bottom moving forward going into the end of this year, especially after school starts in August. Between August and December of every single year, you usually see sales drop by 30 to 40% in most markets. So what's next? That's the ultimate question. Right now, we're seeing price cuts, we're seeing failed listings as expireds, and we're seeing tons of properties come back on the market because they're in the negotiation phases. There's going through inspections. These houses are completely out of date. And I'd love to hear from you. Comment if you agree you've seen this out there. Basically, people trying to get max price for their house and it's not even upgraded. But Florida is leading in the major metros for places where home values are dropping. You can see this across the board in this Realtor.com report saying home values are falling in 10 major metros. Florida dominates the list. You can see 6 of the top 10 are in Florida, including Tampa and Jacksonville, where I'm located. We're seeing them basically drop 20%, 20 grand every single year on the median price, which is quite significant. We're seeing 5, 10, 15% declines, especially around areas with new construction. It is a new construction story. There's areas of Jacksonville that are still doing very well that aren't built around new construction. But if you're an existing homeowner that's trying to sell your house and you're competing against new construction, how are you going to compete against the buy downs of the $50,000 to $30,000 to get folks at a 3 to 4% rate? The sellers just don't have the money to be able to compete in that regards. And so that's what we're seeing right now. We're seeing the sellers try to compete. They're doing price cuts and relisting. Locally, we're seeing up to 33% of listings get a price cut every single week. That's where you see this price change right here, 2,400 price changes. This is in a 1 week time period. You're seeing new listings outpace the closed sales and pending sales. And we have a massive number of expired listings that didn't sell in that week that then generally come back on the market at a lower price where they're more realistic. So we're seeing a lot of changes happen in the market in a very short period of time. That's why it's important to follow a channel like this, where I'm going to share with you exactly what's happening on the ground from an operator level view with hundreds of agents and thousands of transactions every single year. I'm going to share with you exactly what we're seeing. You can also follow me on X and on Instagram. My information is below, but I want you to have this message takeaway. So basically, the math no longer works for this market. Florida does simply too many pre-supplied mid-level luxury homes. The problem is the payment required to support those prices no longer matches the local economic reality. And since demand has basically fallen from domestic net migration and international immigration, we're going to continue to see a massive supply glut moving forward. So look, if you need help in your situation, you're a buyer, seller, renter, whatever, reach out to me. You can email me. I respond to every single email. I'm more than happy to help you with your situation. And then secondly, I'd love to see what you're seeing on the ground in your specific market. Comment down below. As always, you can follow me on Substack, johnbrooks.substack.com, where I talk about things I can't talk about here on YouTube. And I'd love to connect with you if you need any help at all. Look forward to seeing you next week. And my live video will come out on Friday at noon. Look forward to seeing you then.